Okay, I welcome you to our panel session on fractional reserve banking, where we're going to have a serious theoretical discussion in economics about the nature of fractional reserve banking. And on my left side, we will have our two speakers that already gave their lectures, that is Dr. Nikolay Gertchev and Dr. Dave Howden. And on my right side, we're going to have tomorrow's lecturers, Michał, Gamrot and Maciej, Bitner. We're going to start, I have the scenario written down, how many minutes we will have for each of the sides. We're going to have responses, and then responses to responses, and then responses to responses to responses, and so on. And then after some time, after all those responses, we will have some amount of time for you to ask questions, short questions, not short lectures, but short questions. So let us start with this side, with Michał and Maciej. 10 minutes.
Good evening. I have a distinct pleasure. Sorry, is it okay right now? Okay. So I have a distinct pleasure to present first few arguments in favor of fractional reserve free banking system. I will start by stating the obvious. A fractional reserve free banking system is best because it's free. There are no external limitations, no government regulations, no regulations prohibiting what would be a peaceful utility maximizing behavior by both the banks and the customers of the banking sector. Now, to be honest, I could and should end here, but our opponents are not satisfied with these arguments, demand that we give them better excuses for permitting banks to be free. So, here we go. The first argument, the most important argument, is an argument about interest rates. I will argue that a fractional reserve free banking system is a necessary but not a sufficient condition for equilibrating what is a money rate of interest with a natural rate of interest. Now, the natural rate of interest I'm talking about is the same natural rate of interest you find in a Misesian theory of the business cycle, as well as a Swedish monetary school, and also theories of sustainable long-run economic growth. So let me give you an example of what I mean by this equilibration of the market interest rate with its natural level. Let's imagine a person A, who decides to cut his consumption spending and hold more money. Now, this person is clearly engaging in saving. By decreasing his consumption expenditure and holding more money, he increases savings in the economy. A fractional reserve free banking system can notice it and increase credit by a corresponding amount. And this act by the banking system increases investments. So a free banking system increases investments when the demand to hold money is increasing, and by this it equilibrates the money rate and the natural rate. In this case, in the case when people increase demand to hold money, the interest rate, the market interest rate, will also decrease. Now, how is this possible, you might ask? Well, it's possible because of what is called the rule of excess reserves. When when people hold more notes, the banks observe that their reserves go up. And when reserves go up, the banks can increase credit. Now, how is an alternative, 100% reserve banking, how does it fit into this picture? Well, in a 100% reserve banking, when people increase demand to hold notes, they also save. But these notes are not fractional reserve notes. These notes are just warehouse deposits, so to say. So in this situation, the supply of saving is also increasing, but unfortunately, the supply of investment is not. So the money interest rate is above a natural level. The fractional reserve banking system can also accommodate changes in the structure of saving. For example, let's imagine another person. This time this person holds a bond that reaches its maturity, and the person decides that rather than reinvesting the money, he or she will hold to it. Now, a fractional reserve banking, through the same process, the process of excess reserves, recognizes that the amount of savings did not change. Only a way of saving has changed. People were previously holding bonds, now they are holding bank liabilities. And so it will not permit for the level of investments to fall. An alternative, that is a 100% banking system, will cause a level of investments to fall, again making the money interest rates higher than its natural level. So this is a, let's say, long-run economic growth argument. Now let's move into more serious argument. Proponents of 100% reserve banking, especially of the Austrian flavor, often claim that a fractional reserve banking system can result in what is called a in-concert expansion. That is a situation in which all banks expand at the same rate. Now, you will often hear three different arguments why this might be the case. I do not have time to go into them in detail, nor do I have time to critique them right now. You will probably hear them in a few minutes. But for the moment, just remember when you hear them that they all are based on one way or in one way or another on a cartelization argument. That is, they are all based on an assumption that a banking system can engage in a market-wide scheme. It can coordinate itself and that it can expand in concert. Of course, everything is possible, but I should rather say everything is possible in theory, but in reality, different scenarios have different probabilities, and I strongly believe that the scenario of in-concert expansion is inconsistent with what actually happened in history, for example, in a Scottish example. So let me end by presenting a short empirical argument, only hoping that our opponents will do the same when they propose their arguments. So, a fractional reserve free banking system was actually tried in history from 1720s to 1845. Scotland had a relatively free banking system. Of course, when I say that it was free banking system, I have to mention that there were a few regulations, for example, a ban on small banknotes, that is banknotes below £1, and there was also a ban on what is called an option clause. That is a possibility, a possibility for a bank to suspend its payment for a short period of time in return for interest payment to the holder of banknote. Now, a free banking system in Scotland was a system that operated on fractional reserves. These reserves were very low, as high as 1 or 2%. And this system operated through a long period of time with very few instances of bank failures. Of course, there were some bank failures, but this is normal. Every company should fail if it does its business incorrectly. But the good thing about the Scottish example, the Scottish banking system, is that the majority of those banks had unlimited liability. So it meant that when the banks collapsed, the depositors, the holders of banknotes, were paid in full by the shareholders. One of these examples is a failure of Air Bank. I don't remember which year it was, but a funny thing is that one of its shareholders was Adam Smith, and all the depositors were actually paid in full. So the Scottish example shows that a free banking system can be a stable monetary engagement, and also that it can accelerate economic growth. In the periods when Scotland had free banking, the growth was much higher than in England, and Scotland enjoyed this high growth that made once poor country almost as rich as England in a short period of time. So, what brought down, this is just a quick point, so you might say, well, if the Scottish banking was so good, why did it end it? And the question, the answer lies in its neighbor, England. England had a central bank, and no, it wasn't because a fractional reserve banking is unstable or was unstable. It was because a king of England wanted to engage in a war with France, so it gave monopoly to the Bank of England. And this resulted in unfortunate instability of an English banking system. It also resulted with an enactment of an unfortunate Peel's Act, which ultimately brought down the Scottish free banking system. So to conclude, a free banking system is a best system because it's free, because it leads to high economic growth, and because it's stable. And these benefits are very important. And of course, a free banking system, as every man-made institution, has its problems, but compared with its benefits, they are, to quote George Selgin, mere quibbles.
Thank you, and now the time for response, 15 minutes.
Thank you. To understand banking and to understand banking contracts, you need to look at the good which is under contract. So first, let's go back and assess what money is and describe it a little bit. Money is a very unique asset in the economy. For financial assets, it holds this position which is really defined by two characteristics. On the one hand, it is available at par value. Par value means that the value is always the same. $1 equals $1 equals $1, always everywhere. The other characteristic is that it's always on demand. Whenever you present a dollar to make a purchase, it's instantly available to be used. Now, to contrast this with other financial assets, equity, a stock, it's available on demand. You can always ask to get something for your stock, except you just get a market value, right? It's whatever it's worth at that moment in time. You could have a bond. The value is set by par. If you bought a $1,000 bond, you're going to get $1,000 back, except you have to wait a time period in order to get it, so it's not available on demand. Money is the only financial asset which is available at par value on demand. Now ask yourself why you would hold money. Money is held for only one purpose, to mitigate and ease your felt uncertainty. If you were fully aware of the extent and when you would need to use, when you would require money, you would never have to hold on to it. If you knew in advance that your rent was 750 euros on the 28th of every month and you got paid on the 1st of every month, you would never hold on to cash to pay that expense. Why? Because cash doesn't pay any interest. You're not earning any profit on it. You would invest your money for those days and have the investment redeemable on that day when your rent is due. So money is only held to ease your uncertainty. Ask yourself then, what is a deposit? A deposit has all of these characteristics as well. It's available on demand. When you use your debit card, it's instantly available, just like when you go into a store and you use cash, and your cash is readily available on demand. Your deposit is also at par value. $1 in your bank account and your deposit account is equal to $1 in your pocket, is equal to $1 anywhere else in the economy. In other words, a deposit is a perfect money substitute. Currency, cash in your pocket, is the exact same thing as money in your deposit account in these two regards, that it's available on demand and at par value. Now ask yourself, when you deposit money in your bank account, when it just sits there, is it idle and not being used, or is it serving a purpose? Again, the only reason that you hold on to cash is to mitigate your felt uncertainty. The very act of putting money into a bank account means that the money sitting there is being used by you. It's being used in the sense that it's lying, waiting for that emergency that you don't know when or where or the extent of which is going to happen, but if it does happen, you've got that sum of money sitting in your bank account to use as a cushion or an emergency fund to use in such an event. Now, fractional reserve bankers don't view money sitting in a bank account as serving a purpose. They believe it's idle, that it's not being used, and that you don't actually want it. So they go ahead and use it and loan it out. And ask yourself, what are some of the results of a fractional reserve loaning this money out? Well, on one level, you've got a significant conflict. The depositor has put the money into a bank account because he or she expects it to be available in case they do have this emergency. And again, you can't predict when this emergency is going to happen. It's fully uncertain, and you don't know the extent to which it's going to happen. What does the bank do with it? They treat it as if it's their property. They put it to use. They put it to use by loaning it to somebody else, by issuing a mortgage, or giving a consumer loan so somebody can purchase a car. The depositor still thinks he has access to his deposit. In fact, he still does, right? It's always available on demand at par value. And yet the money's not actually there. It's been lent out to somebody else, and that person is using it. So we have this irreconcilable conflict where we have a depositor thinking he has access to the money and that it's his, and you also have the person who received that loan or mortgage who is using the money, has access to it, and also thinks that it's his. Now, fractional reserve bankers will note that generally this is not a problem. As long as they prudently manage their reserves and make sure that whenever a customer comes in to ask for his deposit back, as long as they can give something to that depositor, nothing bad really happens, correct? Nobody's upset about the fact that their money got lent out, as long as when they ask for it, they get something returned to them. Let me use a little bit of a different example and see if the conflict makes more sense. My wife and I just took a vacation this summer, and because I'm not exactly a desirable man, I had to give her a really nice diamond ring when we got married so that she would marry me, and she didn't want to take the diamond ring with her on vacation. So we went to our bank and we put it in a safety deposit box. We made a deposit, in other words. We went on vacation, and when we were away, imagine that the banker was all excited because there was a nice diamond ring in the deposit box, and he went and he took it out and he went home to his wife and said, "Honey, look at this great ring. Let's go out and see a show tonight, and you can wear it. But I'm only borrowing it. I'm only using it for the night, and we have to return it in the morning." And she says, "Okay." They go out. They have a great night. They get into a restaurant they otherwise wouldn't have. And at the end of the night, she gives back the ring, and the banker on Monday morning puts it back in the safety deposit box, cleaned, no problems, it's perfectly safe and in the exact same condition. Have my rights been violated? Absolutely. That's my ring, or it's my wife's ring rather. We did not give it to that banker so that he could give it to his wife to go and use, just like we don't deposit our money and entrust it in a bank so that somebody else can go and use it to buy a house or buy a car or whatever have you. That example might seem a little bit abstract because a ring is not money, so let's use an actual money example. Cash and deposit accounts are perfect substitutes for one another. Your money holdings are composed of cash in your pocket or in your wallet, plus some deposits that are in your bank account. Imagine if you were walking down the street and you had money in your pocket and your banker came and took some and you didn't quite know it and lent it out to somebody and then somehow got the money back, the loan matured, and put it back in your pocket and you didn't know. Nothing bad has really happened, correct? Not in the sense that you've lost any money on this deal, and yet you feel a little bit violated, correct? Something which is yours has been used from somebody without your consent. Now, more obviously, the conflict that exists between the contractual mixing of deposits and loans, like in a fractional reserve demand deposit, the conflict is really apparent with a bank run. During a bank run, the question that comes up is, who owns the money or who has a legal claim to it? Depositors or the banks? It's obvious that depositors are going to their banks. They're angry because their money's not there. And why is the money not there? Because banks think that they have the legal claim, that they were entitled to use the money as they see fit. Incidentally, if you look at financial products, money and deposit accounts are the only financial product that suffer from bank runs where people are very angry. Stock markets decline and people run to sell their stocks as quickly as they can. They lose value on it, but nobody's angry because they lost value, not because they lost value anyway. They might be angry because of the loss, but they fully recognize that equity and stocks, even though they have access to it on demand, they only get the market value for it. That's the rule of the game. Think about debt. You might want to sell your Greek government bonds before they lose value. Well, when you go, you might want to sell your debt as quickly as possible, but you know you can't because you've bought debt and you're obliged to hold on to it for the duration. Or if you borrowed money, you can't pay it back until the duration of this borrowing. Nobody gets upset over this position either, this transaction, but people seem to get upset over bank runs, right? We expect our money to be there, we expect to be paid back at par value on demand, and when it doesn't happen, there is a understandable anger. What are the economic results of this conflict in the two contracts? Well, on one level, there's an illusion of wealth. There's an illusion of wealth in the sense that the depositor thinks that he has some wealth deposited in his bank account. It's his security hedge against uncertainty. And on the other hand, there's a claim to wealth in the sense that somebody has used that deposit to purchase a house, to purchase a car, or something of that manner. In fact, there's two discoordinations happening at the same time. One is interpersonal between individuals, and one is intertemporal between plans at different points in time. The interpersonal one is the rights conflict that is happening. People are angry with one another in the case of the bank run because two people are fighting over the claim to the same asset, money. The intertemporal discoordination is the nub and kernel of the Austrian business cycle theory. Plans are being undertaken utilizing too many present goods, too much money being spent in the present, relative to the amount of future goods which will be available at some point in time. What are the effects of these economic discoordinations? One of them is the growth of the financial sector. If you'll notice, banks are very unique in the economy because they're the only business which is allowed to operate under the legal privilege of making use of something which is entrusted and deposited in them. In other words, they're the only people who can use a source of funding twice. This is drastically different than other types of deposit institutions. Take grain elevators as a prime example. Farmer harvests his wheat at the end of the season, takes his wheat to the grain elevator and deposits it in it. The grain elevator owner is not allowed to make use of the grain. He's not allowed to loan it out to the bread manufacturer or otherwise try to make money off it. He must keep a 100% reserve of grain in there. Incidentally, once upon a time in the 1860s in America, grain elevators tried using fractional reserves in their elevators. The result was mispricing in the grain market. There was a summer of very drastic mayhem as grain prices were all over the place. And the federal government banned the practice as it regards depositories such as grain elevators or silos. What's another side effect in the financial sector or the banking sector? Banks are very profitable businesses. Look at the size of banks. They're quite big, if you think about it. And why is it that banks grow to such large sizes, for example, like we saw in my presentation on Iceland yesterday? Why is it that they grow so large? Well, think of the cheap funding that they have. Deposits are the cheapest funding you can imagine. We all know that when you deposit your money in a bank account, you don't get paid anything for it, or if you get paid something, it's very, very small, especially right now. Banks use that very cheap funding, or even free funding, to fund their own investment and lending operations, so in effect they're getting a free lunch, right? They're not paying for the resources that they are then using to support their own banking operations. Who else benefits from such a situation? Well, how about the people who make use of the loans and the mortgages that banks issue against the fractional reserves? They get to use this fresh money, spend it on something, a new house, a new car, and through that spending, prices rise in the economy. In this way, they get to buy an asset at the old price, while the rest of us are harmed in a way because as all prices rise, we have to pay more to buy the same amount of goods. This is what we call a Cantillon effect, right? As money is injected into the economy through fractional reserves, prices rise slowly, but the people who access the money first, debtors, are the ones who gain at the expense of those who access the money last. On a related note, we might ask the question of why are banks considered in many cases today too big to fail? Too big to fail is probably one of the most salient aspects of the current crisis. And if you were to look around and try to identify, or if I was even to just ask you, give me an example of a company which is too big to fail. Almost every example that you would give me, every example you would give me would be a bank, correct? Why is it that it's only banks and financial institutions which are considered too big to fail? Well, they're too big in the sense that they grow larger than they otherwise would using a resource, the deposit base, which is actually not theirs to use, and they're considered too big to fail because they're systematically important. We have grown reliant on debt financing through the banking system because debt and loans are so cheap given the fact that banks are using this source of funding which they don't actually have to pay for, and they're not supposed to be using it. think about the assets and the investments that banks are making with the money, your deposits. They're all bad assets in a sense. They're bad assets and bad investments in the sense that they're not supposed to be purchased in the first place. You didn't deposit your money in the bank to make money. You deposited your money in the bank for safekeeping, to protect yourself in that event that an emergency happens or some uncertain event which is bad and requires emergency funding arises in the future. Since all of these investments and assets are financed and purchased with this created money, they must all be considered bad in some sense. And this is also part of the nub and kernel of the Austrian business cycle. Now, as depositors look at banks and they realize the extent that banks have made bad purchases and bad investments, or in other words, have just generally made many mistakes, the problem of the banking sector becomes apparent. The problem being banks don't actually have enough assets to honor all the liabilities, all the deposits that people have claim on. So as people go to their banks to start withdrawing their liabilities so that they can make sure that they get their money, the bank run is set in motion, and this compounds the problem of your bank being solvent. In the end, a bank run occurs, possibly your bank goes insolvent, and it's at precisely this moment that the illusion of wealth that the fractional reserve banking system creates turns into be the reality of scarcity of capital, which is a reality.
Okay, thank you. Now, 15 minutes for you.
Okay, so this time we'll split this 15 minutes. I will start. The theme that kept coming back in your response to what Michał said is that depositors they deposit money for safekeeping, and that they are not aware of the fact. In my opinion, you seem to tacitly assume that they are not aware of the fact that they engage in a special contract, which is not identical to holding base money. And this contract, the demand deposit, is I see it as an interesting and useful product that meets demand of at least some consumers. And my personal view is that it's very attractive, and it's trying to generalize this personal view on the rest of mankind, I would see that it would be hard to find anyone who would completely avoid that product in his asset portfolio. And here is why. So I don't agree that the banks, they don't pay anything for keeping deposit in their bank. First, usually having this deposit is free, so the depositor doesn't have to pay. Like, he doesn't have to pay for storage, and usually he doesn't have to pay for transfers and many other operations. And also, he gets interest, because we say deposits, but the cash accounts are not only form of deposit. Most money is kept on term accounts that are technically also demand deposit, because you can end them immediately and get the money. And here the interest is much higher than on a checking account, which I agree many times is simply zero. You get but you keep only a small fraction of your deposit portfolio on a checking account. So what, in my opinion, advocates of 100% reserve banking want to do is to ban this interesting and useful product. I tried to explain why it's useful from the perspective of a consumer. Now, let's look at it from the perspective of the whole economy or the industry. So, in my opinion, it's a powerful vehicle to mobilize savings because and transfer them into investment, because without that product, a person who would like to, who would have some surplus to save and to invest, would be presented with a choice of 3 types of assets. One option is to stay fully liquid, so invest in cash. Another option is to, of course, is to consume, and the last option is to freeze the money in a term deposit that cannot be taken before the term. And for many people, this last option is very uncomfortable. They don't want to. Of course, you might say that if you have a secondary market for term deposit, you can liquidate them. But such markets are not very popular even now, although the transaction costs have fallen, and it's very hard to imagine them in 19th or 18th century. And in my opinion, this particular type of contract, this demand deposit, it enabled a massive accumulation of savings, of people who wanted to save, but they didn't want to lose contact with the money entirely. And empirical research shows that the more developed the financial and banking sector, they usually move together, the higher the economic growth of the country and the higher the economic development. So maybe I will leave some time for my...
Okay, so let me make a few claims about bank runs. Well, it is often assumed that a bank run is a run for redemption. That is, people are running to the bank because suddenly they realize that, actually, the bank has issued more money and we cannot redeem this base money all demand all at once. But what we see in history, what we see in a Scottish example, when people wanted to accumulate more money, it was usually in form of banknotes. Let me go back to the example I gave, an example about English monetary system. In England there was a Bank of England, which was England's central bank, and it had a monopoly over note issue. And in London and in regions, in parts of England next to London. So other banks could not issue money, and their customers sometimes wanted to hold more money in form of banknotes, and it was impossible for them, so they demanded gold, which was the base money in the system. Now, if there is a system in which banks cannot, if there is a system in which banks can issue money substitutes, that is fiduciary substitutes, then the bank run can be stopped by increasing the supply of paper money. The problem with bank runs is that sometimes they might be redemption runs, that is, people would like to hold more gold. And a fractional reserve free banking system has an institution that can stabilize this redemption run. And this is an institution of an option clause. Just as I've mentioned before, an option clause is an option usually written on a banknote that says this note is redeemable on demand, but if the bank for some reason is unable to redeem it in the base money, which is usually gold, we will pay interest to the bearer of this note, let's say 5% per year. So if people accept these notes, they have a form of insurance against a situation in which all people demand gold, that is redemption media, And in this way, this institution, the institution of option clause, has a stabilizing effect on the banking system. Now you might ask, but why would anyone want to hold to such note? It's not so sure that you will get this money after all. And why would this note circulate? Well, historically, the notes that had option clause written on it circulated at par, that is, at full value. That is, they were very good money substitutes. Of course, the option clause was banned in Scotland. It was banned in 1765, I believe, through the unfortunate event. It was banned because two major banks in Scotland were lobbying for the ban on the option clause in order to get rid of their competitors. This unfortunate event had limited the ability of Scottish banking system to deal effectively with the redemption runs, but nevertheless, the option clause could be used successfully in mitigating redemption runs. Also, there is an interesting situation that happened in United States, if I remember correctly. This is a situation when a bank contract said that if the bank is not able to redeem all notes on demand in the demand medium, that is gold, it will redeem it indirectly, that is by giving the people who deposited gold stocks or banknotes of other banks. So if people actually thought, and if they signed these contracts and if they understood them well, this situation in which they cannot redeem money and their banknotes into gold is not utility decreasing. It's consistent with utility maximizing behavior because people had already agreed to these types of contracts. So all in all, I think that the bank run claim of the supporters of 100% reserve is both historically inaccurate, that is, in systems that can be called free banking, those bank runs did not occur. And since we are having a debate of fractional reserve free banking, that is a banking without any government regulation, this is very important. And also the banks, even if there are redemption claims for them, they can add option clauses, which is a market solution to this problem.
10 minutes.
Okay, let me first of all address the very important question of the monetary equilibrium in a free society, so to speak. So what is the problem? So we start from an increase in the demand for money. And the claim of the free fractional reserve bankers is that you need an increase in the supply of monetary objects by the banking system in order to make sure that this increased demand for money will be met properly without causing some disequilibrium in the investment and production structure in the economy. So I believe that this argument is wrong for the following reasons. An increased demand for money is always an increased demand by specific individuals. Some people, for whatever reasons, begin to value cash balances more than other goods and services in the economy. So they move up in their valuation scale. There's a change in the marginal utility, so to speak. How do individuals then react? In a very simple way. They sell more of other goods, including labor. They are more eager to forego other goods. And by the very fact of holding more money, of increasing their nominal holdings of cash, they bring about, those who demand more money, they bring about a tendency of decreasing monetary prices in the economy. I mean, this is really a key argument which is absent from the free fractional reserve bankers literature. The increased demand of money imply a decline in monetary prices. This has two very important implications. This means that a single monetary unit is now providing more monetary services, so to speak. The demand for money is always the demand for real cash balances. we always hold nominal units, but we value them based on how much other goods one can purchase with one monetary unit. And whenever the monetary prices go down, the capacity of a single monetary unit to provide monetary services, that is, to buy future goods in the future uncertain world, is higher. So this very fact of lowering monetary prices implies that the demand for money is satisfied. And notice that the increased demand for money is not an abstract concept. It's always specific individuals. And by their own actions and the price mechanism, their higher demand for monetary services gets satisfied. Then the lower monetary prices, of course, imply that with the same amount of cash and capital, entrepreneurs can now attract more factors of production. So the alleged insufficiency of investment opportunities is also solved by the price mechanism, as in the case of any other good. Now, what happens when the fractional reserve banks increase the money supply by providing more credits? They offer more deposits or notes. Notice first that they have no clue who is demanding more money. Definitely, this is not the person that shows up to get a loan. Whoever gets the loan spends immediately. This is definitely not the person that has a higher demand to hold money. So first there is a knowledge problem, and second, what is the macroeconomic implication of increasing the money supply? Well, in higher prices than otherwise. Higher monetary prices than otherwise means less monetary services by a single monetary unit. This means that actually an increased supply of money supposedly engineered in order to meet a higher demand for money is disequilibrating the relationship between money and goods in the economy. Individuals now are in a sense poorer, and those who demand more money have actually to forego more of the other goods because prices are higher than otherwise in order to satisfy their higher demand for money. This, I believe, is a very important basic law from monetary theory that Rothbard and Mises have taught us, and is key. Now, I would like to address also a few other things. At the very first presentation, the claim was made that the proponents of 100% reserve banking always imply that there is some form of cartelization between fractional reserve banks. And I must say that indeed this is the case. And this is already implied by the claim of the fractional reserve free bankers that some banks can, by the clearing mechanism, restrict an overexpanding bank. The way to restrict an overexpanding bank is first to collect its notes. But how do you collect the notes of an overexpanding bank? By providing it de facto a credit on the interbank market. And by providing a credit on the interbank market for a short period of time, let's say a month, throughout which you accumulate the notes of the overexpanding bank, you are de facto holding them. So you are entering, indeed, into a cartelization of a sort, which I would not call a cartelization, but simply a mutual recognition between the different fractional reserve banks. And they need to mutually recognize their own notes by holding them and by extending to each other credits on the interbank market, because who else would have recognized a fractional reserve banknote in the first place? Of course, your fellow the financial institutions which know what this business is all about, not the individual who has no clue. So these are the two elements that I wanted to make, and maybe David will add.
3 minutes. Okay, I'd like to comment on the use of suspension clauses, such as the option clause, to stave off bank runs. Now, it's interesting if you look at the literature, the theoretical literature on fractional reserve free banking. Bank runs are not supposed to happen. In fact, the demand to redeem money is supposed to be stable. This is an event which theoretically should never occur. Yet in every empirical example that we have of a fairly otherwise successful fractional reserve free banking system, such as Scotland or America between 1837 and 64, we have examples of panics and bank runs taking place, something which is not supposed to happen. You can definitely take care of these with an option clause. Much like when the stock market is falling apart and you're losing a lot of money, you can take care of that problem by stopping people from selling their stocks, right? If we just make it illegal to sell a stock, the price can't possibly fall any further. If we have a bank which can't afford to give everybody back all the demands that people are placing on it, we'll just make it illegal, or more to the point, we'll just, doesn't have to be formally illegal, but we'll just disallow you from actually redeeming what is properly yours, your deposit in the bank. Now, incidentally, our colleagues have noted that this was illegal in the Scottish system, and it's also illegal in the American system. The expert on the Scottish example, the greatest historical work on it is by a man, G.L. Checkland. He describes the Scottish free banking system as one of almost continual suspension of payment. Now, this is something which is illegal. It was never enforced because what kind of a government is possibly going to enforce the illegality of suspension of payments if it means that banks are going to become insolvent and depositors are going to lose their money? Likewise, in the American system, it's illegal, but the American free banking example was one of also periodic suspensions of payment. Why didn't the federal government ever enforce the law which said, no, you cannot unilaterally reassign the obligations of the contract and disallow your depositors from getting back what they've rightfully entrusted with you? Because, of course, it would have made the bank go bankrupt. It would have exposed the fraud for what it was and otherwise harmed the banking establishment. The second point I want to just quickly talk about is the opening statement that free banking should be supported because it is free. In a free society, freedom is not the ability to do whatever you want. I'm not allowed to kill anybody. I'm not allowed to enter into contractual relationships with minors. I can't contract with drunken people. I can't contract through misrepresentation. And most importantly, I'm legally barred from entering into impossible contracts. The fractional reserve demand deposit contract is an impossible contract. It's logically contradictory. Two people cannot have a claim to the exact same monetary union at the same time. A free society would have such a contract illegal, just like we have examples of other contracts in similar situations, which are also illegal.
Thank you. 10 minutes for you.
Yeah. I think both me and Michael, we don't see the point that the demand deposit contract is illogical or contradictory. We mentioned the option clause that tells that the bank gives the money provided that it has the money. So I think we both believe that the depositor is perfectly aware of the fact that entering a demand deposit contract is risky. The risk is minor, the risk is manageable. Michael mentioned also another way to manage this risk, so giving assets to the depositors in case of bank run, not only the note that will pay with an interest, but also actual assets. And so I would agree, I think we would both agree that such contracts are illegitimate if bank misinforms the depositor that the money is always there and it will be available in every possible instance, maybe except theft from our magazine, from our warehouse. So such contract would be illegitimate, but if we openly mention the risk, then why in a free society prohibit such contracts? Maybe. Okay.
Yes. Yes, I also agree with this claim. The Hans Hermann Hoppe type of argument, that is the claim that a banknote is a ownership title to the Bank of Gold, is simply incorrect historically. Unfortunately, I cannot show you the photos of actual banknotes. I have them on my computer, and if you compare the pictures of banknotes, that is fractional reserve banknotes, with deposit claims, that is the money that was held in bank vaults, 100% backed, they are very different. And to say that a banknote in a free banking system is a title to a property is to misinterpret historical examples. Now, I would like to go back to this monetary equilibrium argument. Dr. Gertchev said that an increase in a demand to hold money will result into falling prices. Of course, when one person decides to forego a consumption of an eggplant, for example, the price of an eggplant would go down. But let's think for the moment about what would happen if there is a general increase in demand for money. Now, a general increase in demand for money means two things. The first thing is that in order to get more money, people would have to sell more goods. That is, they have to supply more goods. And the second thing is that they would have to buy less goods. So if at the same time you want to sell more goods and buy less goods, it's rather hard to do. It would require for a price level to fall. I'm not sure about our opponents, but to me, a price level, at least in the short run, is sticky. That is, there are limitations to what can happen with the price level in the short run. So if all people demand more money, the price level have to fall, and the stickiness of prices is a thing that prohibits an equilibration between the supply of money and demand to hold it at a given price level. So this is a thing that we have to keep in mind. Now, you might ask, is the stickiness of a price level a market phenomena, or is it imposed by the government? And of course, in many cases, the stickiness of a price level is caused by external factors, that is, factors external to the market process, such as minimum wage laws or very high costs of firing people. But there are also many processes that exist on a free market that limit the ability of prices to adjust quickly in face of a general increase in demand for money. An example of such problem is the who goes first problem. So when everyone wants to hold more money and prices have to fall, well, someone has to lower their price. But the problem is that if you lower your price, but everyone else in the economy does not do it, you will have diminished profits. And diminished profits are not something that induces additional investment. That this is something that will not make you want to invest more or even lower your price. So the process of equilibration takes a long time, because in order to sell more goods, you have to wait for other people to lower their prices, and this could last for a very long time. So it's rather problematic for a price level to adjust that fast. The other thing I want to mention is that the thing about the bank runs. I mean, it is true that they might happen, and there were some suspensions of gold payments in Scotland, but when discussing them, you have to keep in mind that Scotland operated in an international environment. It had a central bank system in England, and in many cases the central banking system was unable to meet the additional demand, especially the demand for gold. So the demand for gold moved to Scotland, and this is why there were instances of an increased demand in redemption media, that is gold, in Scotland. So of course you might say it is a fault of a fractional reserve free banking system, but you have to keep in mind the institutional arrangements, institutional environment in which it operated.
Okay, so a few more words on bank runs, this time in the United States. So often these bank runs, or mostly, they don't mean that depositors stopped trusting the fractional reserve banks at all. They just want, and they want their gold back. Most of the time they want banknotes. They want to transform their demand deposit into a banknote. And unregulated fractional reserve bank can do it at once. Give the banknote, and the consumer is satisfied, he can pay with the banknote, which might be more convenient in some instances. For example, farmers increased their demands for banknotes before to buy the crops to plug them into the ground, and then they didn't need the banknotes anymore, and it was hard to do it with a time deposit. And when they increased the demand for banknotes, the state laws forced fractional reserve banks to have these banknotes fully covered with state bonds. And there were two problems with it. One problem was that state bonds were scarce, and it was hard to buy state bonds, and sometimes there was not enough of them, and the bank could not issue banknotes. And that started a run. Another option was that there were plenty of state bonds, and in fact the amount of bonds was greater than the capacity to service the debt. So it was bad debt. So the rule forced fractional reserve banks to buy bad state debt, which made them insolvent, and then the run was fully justified on the grounds of solvency, not just some bank panic. Okay, so we'll move to
10 minutes, and then we'll have 2 minutes summing up each side.
Just a brief comment on the American experience. If you want the most pure example of free banking in America, if you go back to it, there's a panic in 1857 which can only be characterized purely as an Austrian business cycle. It has all the hallmarks of real estate and land speculation and malinvestment in the real estate in the railway industry. The demand for money from banks was the demand for inside money, that is, reserves. And banks, because they had overexpanded credits, were not able to satisfy this demand, something which theoretically is not supposed to happen according to free banking theory. And which did happen in the most free example we can possibly come up with. And incidentally, 1857, in most states, laws and regulations such as the requirement to hold government bonds was not in force. I want to comment for a second on the idea that prices are sticky, at least in the short run, and thus if we have a demand-side shock, if people increase their demand to hold money, we should be increasing the money supply to give prices a lift, otherwise we're going to have an output loss. Every time sticky prices was said over the last couple minutes, it wasn't sticky prices, it was sticky price level. Quote, the stickiness of a price level, the price level is slow to adjust or sluggish. The problem on the eve of the bust is not one of all prices being too low or all prices being too high. The problem is some prices being too low and other prices being too high. The adjustment which needs to occur is for those prices which are too high to come down and those which are too low to come up. Increasing the money supply in a general way so as to levitate the general price level does nothing to allow these relative price maladjustments to actually occur. We heard about the who goes first problem. The problem that you don't want to be the very first person to lower your prices if there's an increased demand to hold money and people are purchasing fewer goods. Because if you do that and nobody else lowers their price, your profits are going to decrease. One of the key Austrian insights, which is very distinct about the school, is the imputation theory of value. That input costs are established by imputing their value from the value assigned to the final output good. The who goes first problem is a problem only in the sense that it always exists. It's something which has to happen. The only way that output prices can possibly drop is if somebody goes first, if the only way that input prices can possibly drop is if somebody goes first and drops the price of their output. In other words, a car manufacturer must go first and reduce the price of the cars that he's selling in order for steel manufacturers, leather manufacturers, engine manufacturers to also reduce their costs, cognizant of the fact that the value imputed back is now starting from a much lower level at the reduced value of the final output, the car.
Maybe a few more comments. Maybe on this recognition, so to speak, that a demand deposit on the free market fractional reserve issued by fractional reserve banks would all indeed have some kind of optional clauses, because as a matter of fact it would be an investment instrument. But that's precisely the point in a sense. So this would not be, in my opinion, I mean, of course I cannot speak for mankind, but in a sense this would be precisely not a medium of exchange. People would consider this, if properly explained in what exactly it consists, in a kind of risky investment. Now, assuming that all the other problems about the incompatibility of the mutual claims on a single good have been solved, which I don't think is the case, but let's assume this is somehow solved, then this would be just indeed an investment, a kind of security issued by an institution with a promise to pay in the future. Very good. Maybe this could be used in some businesses as a means for transactions up to a limited extent, in the same way in which Mises speaks of the secondary media of exchange, bonds that indeed could be used to buy a house or to make a big investment. But I doubt that this would be really considered as a medium of exchange. And this is important that you recognize this yourself, I believe. Now, a few quick additional points very quickly on the first points which were made by Maciej. You said that this is an attractive contract which allows individuals to get some interest rate. This is true, but it doesn't come without a cost, and the cost of this type of contracts is precisely what is implied by the fractional reserve system in general. An inflationary environment, the boom-bust cycle, etc., and the number of other disequilibria which have been pointed. So in a sense, one has to discount the interest rate which is paid from all these other costs, one of which is a continuous decrease in the purchasing power of money. Therefore, a much lower real interest rate, if not negative. You said that the financial literature shows that financial deepening or developed financial markets goes hand in hand with the enhanced growth. Well, I think the better claim is to say that the financial empirical literature is inconclusive on this issue. And I'm not exaggerating here. Also on the free market, you said you believe this would be a fantastic investment opportunity. Well, on the free market, I believe people will be investing in equity and in their own funds. This is the idea of the capitalist society. And, of course, in money. These would be primarily, probably, the big investment instruments on the free market. Cash, including money substitutes, in order to cater for the uncertainty of the future, and to the extent that we have a preference for increased returns up to some extent, up to some risk, people will be investing into equity or bonds issued by firms, or self-investments, own funds, into a business.
Thank you. Now, I cannot imagine how you could make a summary of that in 2 minutes. You have so many arguments thrown from different sides. So I'll just ask you to, I don't know, say something as general as possible in 2 minutes, and please do not go into detailed discussions about particular arguments. I mean, it's your choice anyway, but let's start this time with you. So 2 minute statement, summary, whatever, and then we'll leave the last word to them.
Okay. I only want to make 3 points. Money is unique. Money is the only financial asset which has the properties of being available on demand and at par value. When free bankers discuss money, they think it's not unique. They treat it as a bond or any other form of wealth. This is false. Fractional reserve demand deposits are a legal privilege. This privilege is extended to no other depository institution. It's been tried in history with the example of the wheat market in the United States in the 1860s, for example, and it failed miserably. If anybody was to look around the world at all the different depository institutions, and one of them was legally distinct than all the others, would they not think that the one which is the outlier is the one which is doing something wrong or something fishy with its operations? The final point that I want to make is that logical contradictions do not exist. In the case of a fractional reserve demand deposit, it must exist for two reasons. The first is that demand deposits and cash are perfect substitutes. If they're perfect substitutes for one another and cash is available on par and on demand, as those are the two primary characteristics of money and why we demand it as a financial asset, deposit accounts must also be available on par, at par value, and on demand. But since both parties have a claim to the same piece of money at the same time, it can't possibly be available on demand at all times. The logical contradiction is inherent in the very design of the fractional reserve demand deposit contract, and this is the reason why it cannot exist in a free society.
Thank you. That was concise. And 2 minutes for you.
A fractional reserve note is not a title to a property. It never was, and it never claimed to be. To claim that it is a title to a property is a strawman. Fractional reserve bankers do not want banknotes to be claims to property. They are just financial instruments. The beauty of fractional reserve banknotes comes from the fact that they are very liquid. They circulate at par value, that is, at their nominal value, and because of this, they can be used as a medium of exchange. The main benefit of a fractional reserve free banking is that when people hold to these notes, to notes that circulate at par value, are highly liquid and can be used in transactions to pay for goods and services, is that savings are transformed into investments. And this ensures that the growth is fast, that the economy grows at a fast pace. A ban on fractional reserves would necessarily mean a decrease in savings and loss to utility. It would also mean that a capitalist economy would grow at a lower level, which is, I'm not sure, but not something you would want.
Okay, thank you. And now we open the question phase. I have a strict rule. Ask your question within 38 seconds. So, go on.
Okay, 37. Okay, so I want to ask about the 100% banking, because you say that we live in a money society and we also live in a credit society. The case I want to focus on is what if the entrepreneurs see their cost rise exodomously, let's say the oil price rises or the wages rises due to unions or whatever. So what would happen in a free banking system, that banks would extend more credit so the entrepreneur can meet his bills or wages, but the 100% reserve banking, there is some fixed amount of savings, so the market would never clear. So what I believe would happen is that entrepreneurs would or have to lay off people, or they will invent some new money substitutes or go to other commodities. So is there any difference between, in economics with you and free bankers, that the money supply would have to be elastic anyway in response to demand, even if it's not coming from the banking system but from the market itself?
All prices cannot rise unless there's a general increase in the money supply. So the appearance of unions pushing up prices for some wages would not be a general increase in all prices. The second point is the fractional reserve banking system wouldn't extend credit just because prices had increased. It would take an increase in the demand to hold money and more people depositing for the fractional reserve system to actually increase the amount of money. So I don't think the effects that you think are going to happen are happening.
That's true.
The second, third?
Question to Michael. If the money in the bank laying in the deposit are someone's property, what is the legal status of the banknote with warning? Warning, we are going to cheat you with warning of that the bank don't guarantee that will satisfy requirements for the bank. What is the status of the banknote with of fractional reserve banknote? If it is not a property, so what? And how the warning note on the banknote eliminate the ambiguity about what David and Nikolay said, that two persons cannot claim to the one thing at the same cannot demand one thing at the same time.
Well, I'm not sure if I get the point, but the legal status of a fractional reserve note, it is just a short loan, very, very short loan to the bank. This is the legal status. Now, the option clause is just a clause that specifies what would happen in a certain situation. That is, a situation in which too many people show at the bank and the bank is unable to fulfill all its promises to pay on demand.
So and one can say that the loan is automatically revolving. So it has a maturity of, say, 10 seconds with automatic revolving. And with also, as Michael said, an embedded option to that this banknote transforms into a bond. And then you must wait much longer for repayment, but you get an extra interest for that.
A question for Michał. You said that banknotes aren't meant to be banknotes aren't meant to be property titles, presumably redeemable on demand. So would you say the same thing applies to demand deposits, or is it just some semantic coincidence that they are called demand deposits?
Well, I do not claim that a banknote could not be a certificate. Yes, it can be, but the question is whether or not let me phrase it a different way. A word banknote can be assigned to two products: a certificate of ownership of gold stored in a bank, or it can be a fractional reserve banknote. So also the same can be said of demand deposits or deposit. There is no difference. I mean, this is only a word that can be connected with two different financial products.
Like you can think of banknotes and demand deposits, so fractional reserve banknotes and demand deposits, as similar to coins and banknotes. So they are the same, although they have slightly different form. But economically, they serve exactly the same purpose.
Like a demand deposit, which theoretically could not be paid back.
Yeah, of course. I think the demand deposit that also the bank can transform surely at your wish the demand deposit that he cannot pay in specie, and it can transform it to a banknote that it can do at once, and then the banknote can circulate at below its par value. Although if the interest is sufficiently high, it might still circulate at par value. That's logically possible.
Yeah, and notice that there is a tendency for all notes to circulate at par value. If a note circulates below the par value and is a claim that a bank will redeem it on demand at par value, what would happen is that an arbitrage opportunity emerges. People will buy those notes below par value, present them for redemption, and this will equilibrate the system.
That's my question to the proponents of fractional reserve banking. What would be your concise reply to the claim that expanding the supply of money in response to nominal shocks in the conditions of price stickiness is an economy-wide, aggregative, macro-scale response to a problem which requires micro-foundational adjustments in a wide variety of specific circumstances of time and place?
So, I think that, in our opinion, that can be called a micro adjustment, because we don't advocate a central bank to respond, but the whole banking sector. So that means that individual banks would have to observe some movements of their reserves, and they extend or contract credit. So that's a microeconomic response, but with positive macro externalities.
Yeah, that's true. The only macroeconomic thing is that there is money supply involved, and this is a macroeconomic concept, let's say. And by the way, I don't think that a word macroeconomics is a bad word. I mean, it's just a response, microeconomic response to a microeconomic event, so I will not call it macroeconomic.
This time I would like to ask the three bankers, because Michał made a statement that empirically it never happened that there were massive failure of free banks. But you talked about Scotland, and there are of course many successful countries, but what's your take then on the Australian system that went bankrupt in 1892, and even if they paid some creditors or gave them stocks instead of gold or anything, they had huge crisis then?
So I think the question the whole problem of runs that tackles the general problem of banking crisis, and there are many theories on banking crisis, and there's an interesting, more recent paper, and it's a forthcoming book by one of the most one of the best scholars of the discipline, Charles Calomiris, and his general thesis is that the banking crises are generated by the politicization of the banking system, and that's the thesis that is orthogonal, independent from the fractional or 100% reserve banking debate. So if the interest groups capture the banking system and channel the credit, whether it is 100% backed by so-called real savings or fractionally extended by fractional reserve banks, the result is the same. If after some time we have a banking crisis because we accumulate bad debt. So if this general thesis is true, we would have to look for causes of this misdirection of credit in Australia, and that would be the explanation of bank runs, not the structure of the contract of the deposit contract.
Let me answer very briefly about the Australian case. Yes, it is true that the banking system collapsed, and this was mainly, from what I understand from secondary literature, because during the 19th century there was an increase in the supply of gold due to the new gold discoveries. This was channeled to the banking system, and this caused a real estate bubble. So, in a way, it is a free banking crisis, but it was exogenous in the fact that it was not caused by the banking system, but it was caused by exogenous increase in the supply of gold. Now, a free banking system can operate on virtually any base money standard. A gold standard was just one of the examples. I'm not sure if this is the best example, but the best mechanism of base money. But clearly there are problems when the supply of outside money is increasing, and this was the case in Australia.
And I'll add that there are clearly problems when the supply of gold is increasing if we are on some form of gold standard. And no, for me it's connected with the idea of resource curse. So in Spain and Portugal there was a huge increase in the supply of gold, and that was very detrimental to the economies in the long run, because they had a lot of they were running a printing press for 100 years, and they were able to import everything, and they didn't have to produce much, and that had a very bad long-term impact also on the political structure. So the much bigger catastrophe than they would have as a result of a bubble in the banking sector.
Okay, thank you.
Maybe if they have more questions, maybe let's extend it.
So now you're economizing the time. I think
I have a question to Mr. Gamrot.
Okay, the last one, because we're running out of time.
You say that fractional reserve banking allows for a faster growing economy, and you say that we wouldn't want a capitalist economy with a slow pace of growth or a stunted growth. But in fact, what free society, a rational society, would prefer is a sustainable growth. Sustainable growth, real growth. While fractional reserve banking with credit expansion actually creates, well, bubbles and busts in a way. I mean, it creates what you say is a high growth, but it's not a high real growth, because inflation is increasing. So the fact is that the growth in nominal terms is high, but in real terms it's not so high, and what we get is a certain degree of malinvestments. They are just given. I mean, you cannot avoid malinvestments with fractional reserve banking.
Well, I do not agree, since I think that holding money, that is, holding part of your income, is saving. Now, if this is an act of saving, and if banks increase investments because of it, well, I don't see how this is unsustainable. Of course, it might be the case that the person will decide to lower his demand for cash, but this is the entrepreneurial role of the banker to know this. So, yeah, I mean, a free banking system could lead to an overexpansion. It's a man-made institution, so everything could happen. But then incentive structure and historical evidence shows that this is not the case. And if you regard holding cash as savings, then the claim that the free banking will lead to unsustainable growth, let's say, it's simply incorrect.
Yeah, because we believe that a free bank cannot extend credit if you voluntarily don't restrain your consumption. means you restrain your consumption spending. And in a mature free banking system, you don't have galloping price inflation. In fact, it should more or less stabilize nominal GDP, so the nominal income. And if the productivity is growing, you would have price deflation, not price inflation under a mature free banking regime.
Which would lead to an increase of money supply in a reaction to perceived price inflation.
Let's not go into that. To settle it in like short responses, okay? Because whether there's a bubble or not, we still have a few minutes. So. Oh, you want to respond?
Are you closing the debate or not?
Huh?
Are you closing?
No. We still have 10 more minutes, so actually we can extend it a bit. That's what I got. I got 2 minutes for it. You asked for it, we have it. So anymore, we still have a few minutes, so you can still ask the question. Yeah?
Did you say they that fraud in grain storage, so to say, caused malinvestment and bust cycle, or?
Yeah, I wouldn't quite phrase it like that. It's a fairly well-studied case example. And what happened was a sharp increase in the price of wheat and a little bit of a scramble in Chicago in the futures market to cover the losses that happened when the price of wheat skyrocketed. And then the federal government got involved to make the practice illegal of the silos and the grain elevators issuing more claims to wheat than they actually had. So it was more that in the isolated goods market of grains, the prices went up in a hurry. It wasn't a general economic problem, or not a severe one anyway.
I've got a question for the one who sent us. Which system would you prefer? If you have to choose one, let's say 100% but fully government controlled by a central bank monetary system, or fractional reserve free banking system?
Fishery 100% fiat money or fractional reserve free banking program?
I don't see any economic difference between these two systems.
I also don't think it makes any difference because the fractional reserve free banking system ultimately leads to the installation of a central bank. It's a response to crisis management for the panics that it creates itself. So in the example of America, the Federal Reserve is a natural outgrowth of the free banking system. So either option is equivalent.
Yeah, so if you have this 100% reserves with a single paper money producer, basically a single authority determines who will be the receiver of the new media of exchange. If you have fractional reserve banks, well, you have de facto redistributed this privilege to a number of people. One way or another, you will have an inflationary environment.
Okay, so who's in favor of fractional reserve free banking system? Raise your hands. Go on. I'm just asking. Statistically.
There's no one left.
So who's in favor of 100% gold standard? Okay, so who has changed his mind during the debate? Whichever side. Nobody. So this is the point in debating. Everybody stays with their own opinions. Okay, so thank you, gentlemen. Let's give them a clap.